When I think about fundamentals, what I'm looking for is I'm looking for quality companies, and I need to be able to see that these quality companies are going to treat me as a shareholder, as good as they treat their business. Okay. And the hallmark of any great company is how they treat their shareholders. You look at the best companies in the world. I've got Coca-Cola up here. Now this is a Dividend website here, but I look at how they treat their shareholders. Okay. 59 years in a row, they've increased their dividend. Okay. That to me says something. It says a couple of things to me as a fundamental analysis and as a shareholder. It says these people are very efficient at what they do at business, and they actually reward me for being a shareholder, for me putting my investing dollars to work. They're willing to reward me in the fact of higher dividends, right? And they've done it for almost 60 years now. Okay, so that's an important thing. The question becomes, when you start talking about dividends and shareholder, being rewarded, is does the company have the ability to continually reward their shareholders by creating profits or creating earnings? Okay, and this is where our shareholder payout ratio comes in. Now, if you look at this here, this says dividend payout ratio. Okay, it's a percentage. Okay, now this is a percentage of the earnings of the company. Okay, I want to delve a little bit deeper than this payout ratio, because you can look at this and go, okay, they take 76% of their earnings, they give it back to the shareholders in form of dividend. Great, that's awesome, right? However, the shareholder payout ratio is a part, or sorry, it's a more comprehensive look at the dividend payout ratio. Okay. All this tells us is what they're paying us back in dividends to the shareholders. But what I want to know as a fundamental analyst is I want to know what they're doing with the rest of the earnings that they make. Okay. So the reality is how a company spends its earnings or spends its profits in pursuit of either more business or rewarding shareholders. That really, really matters. And I think there's a way that we kind of need to break this down a little bit deeper than what we're just seeing in these basic numbers here, right? So if you look at shareholder payout ratio and we take it into a formula, if you will, basically what it is it's your capital return to shareholders, okay? And we divide that by capital expenditures, okay? So it's two sides of a coin when we think of what the earnings are doing for them, right? Capital expenditures is money that's rolled back into the business, okay? And capital paid to the shareholders that could be through dividends, buybacks, things like that. Mainly the dividends is what we're focusing on here. So now not only do we have this percentage, which is important, if this percentage is higher than 100%, then what that tells us is all the money that they're earning is going to the shareholders, and none of it's going back into building the business. Well, as a fundamental analyst, I'm looking at a longer term perspective. I'm looking at a holistic picture of the company. For me, I don't want all the money to be coming back to me as a shareholder, because what I want is I want the company to be able to continue to build so that 59 years down the road, or 60 years down the road, or 65 years down the road, that they can continue to reward me as a shareholder. So you have to find a balance here. And so the way we can do that is we can figure out a ratio. And what I like to do to figure that ratio out is I will go to Yahoo Finance. Okay. Yahoo Finance. I've got Coca-Cola up here. I'm always using it because it's a good example. I want to go to the financials. Okay. And there's three things in the financials. There's income statement, balance sheet, and cash flow. When I go to the cash flows, okay, I can scroll down and I could see a few different things here. Okay. Right off the bat, I have a category that says dividends paid here. Okay. So they paid out 7.251 or 7.252 billion in dividends. Okay. So that's great. Okay. That's obviously rewarding us as a shareholder. Then I can go down here and I can look at this capital expenditure number. Okay. And at the end of the day, I still want to be able to see that they're spending money on the business itself. So not just giving it all to us, but spending money on the business itself. So capital expenditures, they spent $1.3 billion of their earnings, right, rolling it back into the business and making the business better. So at the end of the day, if we divide this number by that number, it comes out of a ratio of about 5-1. Okay. Now, 5-1 for a beverage company might be normal. The only way that we can use that number is if we compared it to something else in the same vein. So if we go to Pepsi and we look at the same numbers, okay, PepsiCo here, and we go back and look at their numbers, then we can kind of see what Pepsi does with their earnings, right? So we go back to the cash flow statement here. We can see how much they paid in dividends. So they paid $5.8 billion in dividends, and they spent $4.6 billion in capital expenditures. Okay, so their ratio is this 5.8 to 4.6. It's 1.2 to 1, 1.3 to 1, something like that. It's a lot less than Coca-Cola, but it also tells you that they're expanding the business. Okay, they're willing to spend more on capital expenditures, which is also a good thing, right? So yes, I want to get paid as a shareholder, but I also want to I want to be a part of a business that continues to grow. And so if you think about that, you can look at these things in a different light, where it's not just what you're getting, but it's what they're doing, right? So you look at this, their payout ratio is all very similar. 76% for Coke, 78% for Pepsi, 50 years of consecutive dividend increases, right? So very similar numbers, but when you break it down, you can see that Pepsi is spending a lot more on capital expenditures. They're trying to expand the business while still rewarding their shareholders, albeit not quite as much as Coca-Cola from a pure payout standpoint. So anyway, the shareholder payout ratio is not only that dividend payout ratio, but it's looking a little bit deeper in there to see what the company is actually doing and what their future prospects are. As a fundamental analyst, I want to know not only what's happening with the company today, but what I can expect to happen in the future. And so this is what we do in my fundamental society lab. Is we break down concepts like this. Right now, we're in a deep dive in gold. We're getting right down to the feasibility studies. We're getting right down to the nitty gritty numbers to see what gold companies are have a good picture today, but also have potential, great future ahead of them. Because what we're looking for when we start to invest is we're usually looking for a couple of things. We're looking for growth and we're looking for value. At the end of the day, ideally, we'd like to have both of those. But if you don't look, fundamentally speaking, at both sides of that coin, you could be missing out when it comes to investing your dollars into a specific company, or even just position trading a company for a number of years. You really want to know, are you getting some growth out of it? Do you have the potential for growth? Are you getting some value out of it? Are you getting rewarded as a shareholder here? Are they building the business, right? Looking at all these same numbers, no matter what the company is very, very important. And that's what we do in the Fundamental Society. We're building a mock portfolio where we're taking only the best companies. We're going to put it together and see how we can build wealth with these fundamental concepts. So that is all we got for Fundamental Focus today. Shareholder payout ratio, very, very important.